The broadcast is now starting. All attendees are in listen-only mode.
Okay. Greetings, everyone. This is Craig Kahn. I'm the Legislative Counsel here at the Florida League of Cities, and we're going to go ahead and get started. We have quite a few participants today, about 150 folks signed up for this. And if you have questions, go ahead and either send those in or you can wait till the end. I will not take any questions until we get to the end. You should have received an email yesterday that was a document that I produced. It was dated yesterday, June 29th. It's a summary document and a worksheet for the new police and fire pension law. If you didn't get that for any reason, there's two ways you can access it. You can get to it on the webinar docking station. There's a link to it there. And if that fails, then go to our website at the FloridaLeagueOfCities.com, and you can get to it by clicking onto the legislative advocacy. Or at the very end of today's presentation, I will have my email address, and you can send me a quick message and we'll get it to you. So today's presentation and the PowerPoint will be available on the League's website after the presentation. And I think with that, we will get started. So we're going to start off with the bill that did pass and was signed by the governor, Senate Bill 172. It is now law, and it becomes effective tomorrow, July 1st. But there will be a that's the hard date for the effective date of the new law. But each city will basically have its own effective date depending on your collective bargaining cycle. So, what's this bill all about? The broadest concept of the bill is that it basically positions two parties, cities and the unions, and if your city doesn't have a police or fire union, then the actual plan members in the collective bargaining process on insurance premium tax revenues. As we go through today's presentation, keep this broad concept in mind. So what does the new law do to the prior law? And you're going to have to basically change your mindset from the way that it's operated under the last 15 years under the 1999 extra benefits law and under the most recent Naples letter interpretation. So the new law, it does eliminate the extra benefits requirement. It also, in doing that, it also eliminates any comparison of police and fire pension benefits to general employee pension benefit levels. The law does eliminate the statutory basis for the Naples letter interpretation, so that goes away. And basically, as best that the legislature could, it's trying to break away from the old concepts on the use of premium taxes and institute a new day. So, what does the new law do? Basically, it does two things. The law establishes a two-step process regarding the use of premium tax revenues for retirement benefits, and these are only under plans that are operated under Chapter 175 for firefighter pension plans, or Chapter 185 for police pension plans. If your city does not have a Chapter 175 or 185 pension plan, if you offer something different, or you're in the FRS, or you don't have a legacy plan of 175, 185, then this is just purely educational for you. The law encourages a mutual consent process for the use of premium taxes. If for any reason your city basically goes to impasse with the unions on bargaining over premium taxes and there is no mutual consent, then there is a separate statutory distribution process that is engaged. And the new law focuses on the statutory minimum benefits and minimum standards that are under Chapter 175, 185. So in passing this law, the legislature tried to, as best that it could, put the parties, put these issues back at the local collective bargaining process. It's not pure collective bargaining. but it's as best as, it's as far as the Florida legislature was willing to go. And again, the focus is on trying to encourage a consensus, a mutual consent on the use of premium taxes, and focusing on the minimum benefit levels of the statute. So some of this is going to be a little bit repetitive, but I'm still working under the broad concept. Again, the primary concept goal of the law is to encourage the mutual consent of the cities and the unions over how they're going to use premium tax revenues. And as long as the plan provides meets the statutory minimum benefits, with some exceptions that I'll go over, the legislature really doesn't care what the agreement is between the unions and the city on how premium taxes are used. It's whatever you can agree to. However, if you cannot reach mutual consent, as I stated, there is a fairly complicated process that imposes a required use of premium taxes, and I'll go over that in great detail. So, where does this leave folks? Well, as in any collective bargaining process, each side will try to determine their relative bargaining strengths and weaknesses under the law, and basically, you, from the city perspective, will want to work through the worksheet that I've provided to determine how, if there is no mutual consent, what the required uses of premium taxes will be. That will just give you an idea as to where you position yourself in the bargaining process, understanding that your city will be bargaining under a multitude of, or bargaining on a multitude of matters, not just the use of premium taxes. It's going to be a whole collective bargaining agreement on covering other terms and conditions of employment. If there is mutual consent, and I've underscored this and highlighted it, then your city does not have to comply with any of the required uses of premium taxes. As long as your plan meets the minimum benefits, you can agree to whatever it is that you're going to agree to. Now, premium taxes are going to have to be used for retirement purposes. You can't use them to fill potholes. But whatever it is that you and the unions can agree to, or you and your individual employees, if there's no union, then that's fine. You all are going to be considered to have mutually consented until the next round of collective bargaining, and then you get to do it all over again. If there is no mutual consent, then you're going to fall into what I've referred to as the default or the statutory distribution process. It's fairly complicated, as you'll see as we work through it, and it could be, depending on the factual situation of your at your individual city level, it could be more beneficial or less beneficial for you to either reach mutual consent or not reach mutual consent. Okay, moving on to some of the important dates. As I stated, the new law is effective tomorrow. However, in application, it applies to collective bargaining agreements entered into and after starting tomorrow. So if you're currently in the collective bargaining process and you do not have a formalized, fully executed collective bargaining agreement, and then you're going to be operating under the provisions of this new law. Hopefully your collective bargaining agreement more than likely will meet all of the conditions under the law. If you don't have bargaining units in your city, then the law applies to police officers and firefighters that don't have that are providing non-collectively bargained for service on or after October 1st, 2015, and that is going to be the beginning of the next fiscal year. Going back to the collective bargaining agreements, the law doesn't affect anything that's currently on the books. So all current collective bargaining agreements stay in place the way they are, and it's at the next round of the collective bargaining process will this law apply. And typically that's on a 3-year rolling basis for collective bargaining agreements. Okay? Let's start getting into, I've provided a kind of a broad overview. Now I'm going to start focusing on the particulars of the bill in much greater detail. and we're going to start with the mutual consent. And so again, effective on October 1st for non-collectively bargained service and for collective bargaining agreements entered into on or after tomorrow. You all, next slide, our cities and the unions are given the ability to mutually consent on the use of premium taxes, and this includes any accumulation of tax revenue not yet allocated for benefits. There have been a lot of cities that have accumulated premium taxes over the past basically 15 years, potentially since 1999, and the law gives you an opportunity to come to an agreement on how those premium taxes are going to be used, and it's however you and the unions decide to divvy it up. Again, if there is mutual consent, the IPTR, which is an acronym, an abbreviation just put together for insurance premium tax revenue, those revenues are not subject to any of the statutory distribution process. So don't get hung up on all this complicated required uses if you have no mutual consent. If you have mutual consent, you can forget about all of those required uses. Next slide. So what does the law focus on? It focuses, again, on the minimum benefit levels, and I'm going to address minimum benefits in just a minute. But typically, most plans are already in compliance with this. Most plans already operate in compliance with the statutory minimum benefits and minimum standards. But there is an exception. So if you are operating under mutual consent and your plan did not meet a minimum benefit as of October 1st, 2012, your plan does not have to meet that minimum benefit. And that date is the date that was almost immediately after the new Naples interpretation by the Department of Management Services. So if your plan had been a long-term plan that did not meet a minimum benefit level under the 1999 law as initially interpreted by DMS, and you and the unions are satisfied with your agreement on your benefit structure, then, and that benefit structure was in place as of 10/1 of 12, you can continue with that for forever, as long as you are operating under mutual consent. The law addresses some special plans, two types. Special Act plans, those are plans that require an act of the legislature to change the benefit level. And supplemental plans, those are plans that were had a supplemental plan city is a city that had a supplemental plan as of December 1st, 2000. There's about 15 of them in the state. If you're one of those two plans, types of plans, you're going to know who you are. Then you're deemed to have mutually consented as of July 1st, 2015. Okay, so again, if the parties cannot reach mutual consent, then you're going to fall under the default, and I'm going to more to come on that when we get to no mutual consent. Minimum benefits. So back from this is a concept that was developed in the 1999 law, and that is that on an individual city basis, the Department of Management Services basically stated that your city could not go below the benefit levels as your city provided it in 1999. Now, this is pre-Naples letter interpretation, but that concept that was in play is removed from consideration under this new law. Again, the focus of the law is on meeting minimum benefits and minimum standards. If your plan provides at least the minimum benefits and the minimum standards, then you're going to be in a good position. So all of the current statutory minimum benefit levels stay exactly where they are, except for one, and that is the accrual or the multiplier rate. And so effective on July 1st, tomorrow, the 2% minimum accrual or multiplier rate is going to be raised to 2.75%, but there's a big exception. So for basically effective tomorrow, if your plan does not provide for a 2.75% accrual rate, you do not have to raise your benefit level to be in compliance with the minimum benefits. If you have something less than 2.75%, it can stay at 2.75%, basically for forever. The law will not require you to come up to that. There are some minor exceptions to that I'll get to later on, but if you're satisfied with the way your plan is now, and this is even operating under no mutual consent, then you can continue to keep your multiplier where it is today. For any plan that is currently over 2.75%, that accrual or multiplier rate can be reduced down to the 2.75% level. That will more than likely require, collective bargaining to accomplish. But probably what's most telling is that last bullet, and that is currently, of the current police and fire plans, 84% have a 3% or higher accrual rate. And so most of the plans are going to have flexibility because they're well above the 2.57% multiplier rate that's currently in effect. And just as a sidebar, under the Florida retirement system, the special risk class, which is your deputy sheriffs, your sheriffs, and your county firefighters, their accrual rate under the FRS is 3%. So pretty much the standard rate around the state is 3% or potentially even a little bit higher. There have also been cities that, in many over the last couple of years, have incorporated what's called a maximum benefit cap into their plan. And this is some examples of these are that the maximum benefit can, for example, be set at a percentage, that the benefit under the plan cannot exceed, say, 80% of the average final compensation, or some plans even set a dollar threshold, be it $75,000, $80,000, $60,000, $100,000, whatever. These maximum benefit caps are allowed to stay in place at the current level, even if under the maximum benefit cap, you have an effective benefit that is below 2.75%. And I'll give you an example of this, just a quick one. Let's say that your current accrual rate is 3%, and after 30 years of service, hypothetically, a police officer or firefighter would be entitled to 90% of their average final compensation. If you had a percentage limitation, say it was 80% of average final compensation, then even after working 30 years, their benefit's going to be capped at 80%. There is an analysis done by the Department of Management Services to determine if those types of maximum benefit caps don't violate the minimum accrual rates. This is so even under current law with the 2%, well, as of today, the current 2% multiplier. Okay, that's it for benefits. Going to move on to the defined contribution plan component. And that's kind of a misnomer. It's unfortunate that the legislature chose to use the term defined contribution because that always has connotations of a self-directed type defined contribution plan. This is not what that's talking about. This is talking about establishing what's referred to as a share plan into each defined benefit pension plan, adding a share plan component to that. And I'll explain more on that in just a minute. But again, effective October 1st for non-collectively bargained service, or for the next collective bargaining agreement after July 1st, then the law requires the pension plan to incorporate a defined contribution component along with the defined benefit plan component. So each plan is going to incur an administrative expense in adding this defined contribution component to its existing plan. And the legislature wanted plans to have this incorporated in the front end as soon as possible. In order, if there ever was no mutual consent on the use of premium taxes, then this component, the share plan component, would be built into the plan and could be engaged without actually having to amend the plan to provide for a share plan if there's no mutual consent, and then there's some required deposits made into the share accounts. And basically what a share account is, the most simple example is if however many, I'm just going to use police officers as an example. Say like your current police force has 100 officers, and then each officer with just a simplified share plan would be entitled to 1 share of a distribution for a year. And let's assume that the premium taxes that get that are deposited into the defined contribution plan under the no consent, i.e. you're at impasse and have imposed some type of a contract, then let's just assume that the share was $10,000, or the total contribution was $10,000. Then each officer would be entitled to, if there's 100 officers, they'd be entitled to $100 each into their share account for that year. So, as I stated, the creation of the defined contribution plan component is simply an administrative step, and depending on if your city can reach mutual consent or not on the use of premium taxes, the defined contribution component may never receive any funding. It may just sit there on paper in your plan but never be engaged. And just to reiterate, the law does not require that the share plan component be funded in any manner to provide any benefit to police and fire, except when there is no mutual consent and the statutory premium tax distribution process, or the default, is engaged, which would, under various pots that we'll go through in just a little while, may require some money being put into the defined contribution plan component or the share plan. The law refers to the defined contribution type benefits as special benefits if you were to take a look at the law, and any required funding, as I stated, for these share plans is going to be further explained under no mutual consent. So here we are. We are at no mutual consent, and again, I'm going to reiterate these dates. For non-collectively bargained service, on or after October 1st, the mutual consent concept is engaged and effective, and for the next collective bargaining agreement, that's entered into on or after July 1st. So, operating under no mutual consent, which basically means that the city and union are at impasse over the use of premium taxes, and more than likely, if you're at impasse over premium taxes, you're at impasse over a bunch of other issues, other terms and conditions of employment, which probably will include pension benefit levels. And you cannot come to an agreement. And I'm going to go ahead and make an announcement. We're having a pretty severe storm here in Tallahassee, and with some lightning, and so hopefully we won't lose you all, but we will, if we do for any reason, we will get back as quickly as possible. Back on track for the no mutual consent. Under no mutual consent, your plan is still going to have to meet the minimum benefits and the minimum standards, that is relative to all the other benefits except for the accrual rate. The accrual rate is a standalone benefit, and there's special consideration given to accrual rates now with that change that the legislature made, moving it from 2 to 275. So under no mutual consent, your plan is going to have to meet all the other minimum benefits and minimum standards under chapters 175 for fire and 185 for police. And then under no mutual consent, as I stated, the premium taxes are going to be divided into what I've termed various pots of revenue, and the statutes are going to dictate how those various pots are to be used. This is a fairly complicated analysis we're about to undertake, but please don't forget, the concept of no mutual consent is designed to hopefully drive the parties to reach a mutual consent, which means you do not have to follow this very complicated dividing of premium taxes into various pots with required uses. If you and the unions can agree on how premium taxes are to be used, then while we'll go through the academic exercise of determining what your position would be under no mutual consent, but that in actuality will not have to occur. You can basically disregard all the required uses under Chapter 175, 185 for premium taxes if you have mutual consent. So what are you going to need in order to determine if you're operating under no mutual consent? This information, you can link to it under that document that I sent out yesterday, the summary document and worksheet. Under the worksheet, you can link to these various pieces of information, and you can also contact us here at the League, and we can provide them to you. Or you can, again, go to our website under Legislative Advocacy, under the issue briefs, and under Municipal Police and Fire Pension Reform, and it's all right there that you can link to it from there. So you're going to need the insurance premium tax distribution for the years 2002, for the year 2012, for the most current distribution, which happens to be 2013, and you're going to need the distribution amounts for fire and fire supplemental. You're going to need both those for your fire plans, and then for police. There is no police supplemental distribution. So what's the first pot of cash that the legislature is going to require you to create under no mutual consent? This is the base premium tax revenue amount. And it says that for plans in effect on October 1st, 2003, you're going to have to look back a little bit. The base premium tax is the amount of premium taxes that your city received for calendar year 2002. That amount, or an amount equal to that amount of the current premium tax distributions, if you have no mutual consent, must be used by the city to fund the minimum benefit levels or any other retirement benefit levels that are greater than the minimum benefits as determined solely by the city. And then the law does provide, if your plan was created sometime after October 1st, 2003, the law does provide for a base year amount for plans created between 2003 and 2015. So, how's the distribution determined? Again, you're going to take the 2002 fire distribution amount. You're going to add the supplemental distribution that was provided by DMS in September of 2003. Add those two together, and that's your distribution for 2002. Just to reiterate, that the total fire distribution is the amount of both those figures added together. And then, as I stated earlier, so of the current distribution of premium taxes, the city is entitled to use an amount equal to the base premium tax revenue amount to fund the minimum benefits under Chapter 175 for your fire plans or other retirement benefits above the minimums. And you're going to have to do this calculation separately for fire and for police. You cannot do them as an aggregate. I'm not going to spend any time going over the police group because it is absolutely identical to the one we just did with the fire, except to note again that there is no police supplemental distribution. If once you figure out the amount, it's going to be subject to the same usage requirements, and but you'll be operating under Chapter 185 under your police plan. Next. So that's the first pot of cash. The first pot of cash was based. Excuse me. Hang on a second. The first pot of cash was the base premium tax revenue, and now we're going to have two additional pots that are going to need to be reviewed. And these are additional premium tax revenues. And additional premium tax revenues are insurance premium taxes which exceed the base premium tax. And that's going to be important when we get further into this. So the city is going to take the 2002 amount, and then the next two amounts are determined to be additional premium taxes, but their definition is tied to the base premium tax amount. There are going to be two different amounts of additional premium taxes. The first, which I referred to as the gap amount, and that's the difference between the 2012 distribution and the 2002 distribution, which we've already figured out the 2002. And then there's going to be an additional pot of additional premium tax revenue that I refer to as the growth amount, and this is the excess amount of premium taxes over the 2012 distribution. These terms, gap amount and growth amount, are not in the statutes. They're simply terms that I've created just for ease and convenience. Okay. All right. So the first of the additional premium taxes is going to be the gap amount, and that's the difference between the 2012 and the 2002 distributions. You're going to, again, turn to those charts of the distribution amounts from DMS. Look under it for your city, for your fire distribution, for your city under fire supplemental. Add those two together. It'll be the 2002 and then the 2013, October 2013 supplemental. That will be your 2012 total. And you're just going to take the 2012 total, subtract the 2002 total, which you've already figured. And that's the difference between those two is going to be the gap amount. So what do you have to do with the gap amount? Well, the difference between these two amounts, which we just figured out, has to be used to fund benefits in excess of the minimum benefits. You use base premium tax revenues to fund minimum benefits. You use the gap amount to fund benefits in excess of the minimums. However, a little bit further on, if your city does lower benefit levels to something at least higher or at or higher than the minimums, that's probably going to free up some money for a further distribution if those benefit levels are reduced. So the gap amount is subject to a further distribution if the benefit levels are lowered. We're going to get to that in just a minute. Let me go back to this for 1 second. Under that second bullet, again, you're going to be operating under no mutual consent. And so, as I stated earlier, you're probably going to be at impasse over something in addition to the use of premium taxes. And you may be bargaining over actual benefit levels. And remember that the real savings to the city in reducing pension benefits isn't the money that's necessarily generated by the city under premium taxes or freed up under insurance premium taxes. It is very likely the other city contribution amounts that are required to pay for those benefit levels that the city is going to see the real savings from. All right, this scenario is highly unlikely, but the legislature did address it, and that is if for any reason the gap amount of premium taxes, this is additional premium tax revenues, is more than enough to pay for the benefits provided under the plan that are in excess of the minimum benefits, then the excess money is going to be subject to a distribution, and it's 50% to the city to use for the minimum benefits, or is otherwise determined by the city, and 50% to the plan members as a DC contribution for special benefits. Again, it's probably going to be highly unlikely that the additional premium tax dollars are going to generate that type of revenue. And an additional potentially unlikely scenario, however, I have seen two cities for their police plans that fall under this, and that is that your 2002 distribution could be greater than your 2012 distribution. For some cities, their police plans, for some reason, had a very high 2002 distribution and was actually greater than their 2012 amount. So in this case, there is no additional premium taxes for consideration to fund benefits in excess of the minimums. That doesn't mean that those benefits above the minimum benefits just disappear. They're still a part of the plan. But under this analysis for the required use of premium taxes, there is no money that has to be dedicated to pay for that, which means that the city gets the city's base premium tax revenue amount, the 2002 amount, it's fully funded up to basically the full amount of the premium tax distribution, and the city gets to use that to pay for minimum benefits. All right. The analysis that we just went through for fire is the exact same under police. Again, to reiterate, there is no police supplemental distribution. You're going to figure out the 2012 amount. You're going to subtract the 2002 from the 2012 to determine the figure. And then, again, that gap amount, that difference between those two amounts has to be used to provide benefits above the minimums. Again, it's not going to be likely that the full benefit cost above the minimums is going to be paid for with the gap amount, but there is this distribution if it is. And then again, and this I haven't seen any fire plans, but I have seen some police plans where the actual 2002 distribution is greater than the 2012 distribution. All right, the third pot. This is determine the additional premium tax revenues that are in excess of the amount received for calendar year 2012. This is the growth amount. And it's a very simple calculation. You'll just take the fire. Again, you're going to use the most current, but the most current is now 2013. 2014 amounts will be distributed in September, October of 2015. They're just right around the corner in a few months. So you're going to determine the current distribution and then subtract the total current distribution from the 2012 distribution, and that's going to give you the amount in excess of the 2012, and that's what I refer to as the growth amount. The growth amount, again, is this difference between the current and the 2012, and it's subject to the 50-50 split. That is 50% to the city to use for minimum benefits or other benefits that the city determines, and 50% to the officers for their defined contribution. And I'm going to reiterate again, all of these figures, all of these pots we just went through and determined the amounts. If you operate under mutual consent, you do not operate under any of these required uses for premium taxes. You and the unions or you and the employees have agreed, come to an agreement on the use. It could be 100% of the premium taxes goes to the city. It could be a 50-50 split. It could be anything in between, or even 100% to the employees in a share plan if you wanted to. That the legislature doesn't care how you decide if you operate under mutual consent, as long as the minimum benefits of the statute are met with those exceptions I just went over. Do the same thing for police, same analysis. Determine the most current distribution. Then you subtract the most current from the 2012, and that gives you the difference. And that difference is subject. All right, the next pot of cash, which this will not be applicable to most cities, and that is if you have an accumulation of additional insurance premium tax revenues. And these are basically revenues that haven't been allocated or used to provide benefits in excess of the minimums. This is the old extra benefits from 1999 to 2012, the extra benefits pot of cash, and potentially some additional revenues that have not yet been allocated. The city and the unions, or for whatever reason, have not been able to come to an agreement on how to use or allocate those funds. If you operate under no mutual consent, there's going to be a mandatory distribution of those funds. 50% will go to the employees as a defined contribution deposit for special benefits, and 50% will go and have to be used to fund any unfunded actuarial liabilities of the plan. It doesn't go to the city to use for minimum benefits. It goes to backfill unfunded actuarial liabilities. So, and then, as I stated in this final bullet, there actually have been several cities, at least several, that have these this accumulation, and there will, under no mutual consent, be some type of a sweep of those funds. But as I stated earlier, remember, if you operate under mutual consent and you have an accumulation of unallocated funds, you can come to an agreement as to how those funds are going to be used. It doesn't have to be this 50-50 split. 50% of the city to go to UAL. It could be that the city gets 100%, could be that the members get 100%. It could be a 50-50 split, and the city is allowed to keep the money to pay for a normal cost and not have to backfill any unfunded actual liability that it may not have to pay for today, but it may be required to pay for over the next term of years. All right, so we've kind of gone through most of the pots of cash that are created. Now, if you are at impasse, which means you're operating under no mutual consent, so you're at impasse, then you do have the opportunity to lower benefit levels. You can lower your plan benefit levels all the way down to the minimum benefits. So anything that's in excess can be lowered down. Again, this will be working through the collective bargaining process, and you'll reach impasse and then have to make your elected officials and the city administration will have to make some hard decisions as to what the package of terms and conditions is going to be for your employees. The amount of premium taxes that were previously used to fund benefits in excess of the minimums, this is that gap amount. This is that difference between the 2012 and 2002 amount of cash. That is subject to a distribution. There are some exceptions, as there always are with anything the legislature does. So, first exception. If you currently have, or if there was a supplemental plan, if your city had a share plan in effect on September 30th, 2014, there have been at least 40 or 50 of these share plans created statewide, probably a lot more, I'm just not familiar with, then the supplemental plan benefits cannot be reduced. Now, well, the benefits themselves hypothetically can't be reduced. However, the third bullet is the amount of additional insurance premium tax that went to the supplemental plan for calendar year 2012 will continue to go to the supplemental plan. Now, this money is tied to being additional insurance premium tax revenue. Additional insurance premium tax revenue, by definition, are revenues greater than the base premium tax revenues. If for some reason your city has a very high 2002 distribution, there may be no additional premium tax revenues available to fund the supplemental plan based on what the current distributions are. It could be that your 2002 distribution is equal to, greater, or just slightly lower than your current distribution of premium taxes. And by definition, if you're operating under no mutual consent, then your city would be entitled to keep the 2002 amount, an amount equal to that amount, and use that for the minimum benefits. But hypothetically, that's not going to, for the most cases, that's not going to happen. And so if there is this gap amount, the portion that went to the portion of the additional premium taxes associated with the supplemental plans is not subject to being redistributed. So there's the exception for the share plans. What is available to be reduced? Well, any defined benefit type benefits, supplemental plan benefits not in effect on September 30th, 2014, or other plan benefits in excess of the minimums can be reduced all the way down to the minimum benefit levels. Again, remember, you're operating under no mutual consent, which means you're being driven to impasse for some reason, and it means that you're probably going to have to reduce benefits in order to obtain the savings that your city needs in order to meet whatever budgetary circumstances you're operating under. So, minimum benefits. If you look at the statutory minimum benefits, they're not that excessive. If your plan, for instance, offers a cost of living adjustment, there is no requirement under the statutory minimums to have a cost of living adjustment. You can eliminate it if you are driven to impasse, and you can and you have to take action on benefit levels. Deferred retirement options, chapters 175, 185 do not require require a drop. You can eliminate that. Any benefit level that is above the minimum, if you have an accrual rate that's above 275, you can bring it down to 275. There are numerous other benefits that more than likely your plans provide a benefit greater than the minimum benefit, and this is subject to being reduced. One exception, that your plan must meet all the minimum benefits, including providing a minimum benefit of at least 275 before you can reduce any other benefits down to the minimum benefit levels. And then subject the premium taxes that are associated with this to the distribution. As I stated, any premium tax that was previously used to fund the portion of the benefit that was reduced is again subject to the distribution, and that's the 50-50 split. More than likely, the actuaries will have to get involved to try to figure out how much premium taxes were being or were associated with various benefit levels above the minimums. But hypothetically, let's say if your gap amount was $200,000 and your city reduced benefits all the way down to the minimum benefit levels, then that $200,000 would be subject to the 50-50 split, $100,000 to the city to use for the minimum benefits, and 50% to the plan members as a share for the share contribution. All right, I know our time is getting near, and I'm almost done with the presentation. Thanks for your indulgence. The law does provide for new plans, and that is for plans created after March 1st. Again, if you're operating under no mutual consent, it's a 50-50 split. 50% of the money goes to the defined benefit, pay for the defined benefits, 50% to the defined contribution. Again, I emphasize, because very many plans are not going to be operating under new plans, will not be operating under no mutual consent. If you have mutual consent, you can, whatever the agreement is, the city can get 100% of the money to pay for the defined benefits, or the employees can get 100% into a DC or anywhere in between. The Naples interpretation. The legislature did create a grandfather for those cities that have relied on the current DMS interpretation as reflected in what we call the Naples letter interpretation. So your city is going to have to either have implemented or proposed changes in reliance on the Naples interpretation to your 175-185 plan, and it had to have taken this action sometime between August 14th, 2002, which was the actual date that the city of Naples received their letter, and it was the date of the letter, and March 3rd, 2015, which was the opening day of session for this past session. The grandfather will require some type of evidence of reliance. There's going to have to be some type of communication that has occurred in the collective bargaining process, either a proposal or an agreement, or correspondence with Department of Management Services. And it's going to have to specifically identify what the changes are that are basically below the minimum benefit levels. And then if you meet these conditions, then the law does provide for a 3-year grandfather. You can continue to provide the the benefits that don't meet the minimums up until October 1st of 2018. This is just an additional protection for those plans if for any reason you don't fall under any of the other exceptions for not having to reach the minimum benefits. All right. The law requires police and fire pension boards of trustees to adopt and operate under an administrative expense budget and to have some type of an annual accounting performed. The annual accountings, if the board has a website, must be posted to their website. What are administrative expenses? They are listed in the statute, and they include expenses relating to legal counsel, actuary, plan administrator, all other consultants, all travel and other expenses paid to on behalf of the members of the board or anyone else on behalf of the plan. Many plans already create some type of an administrative expense budget, and this is the legislature's desire to provide more transparency for how public funds are being used. Now, interestingly, this provision does apply to various special act plans as noted there, so this will also pick up the cities of Jacksonville, Miami, plans that operate the police and fire plans in Jacksonville, Miami, Coral Gables, and Miami Beach. The law provides for some clarification from the 2011 law, and for police plans, and it clarifies that the definition of compensation or salary under the plan can limit the use of overtime for plan purposes before July 1st, 2011. The law prior to 2011 set a minimum of 300 hours of overtime for use for police plan purposes to determine compensation, average final compensation. And this was changed in 2011 to be a maximum, not a minimum of 300 hours, but a maximum of 300 hours. And the law needed a little bit of tweaking to make it clear as to how that was to be implemented by the Department of Management Services. So what's repealed? As I stated earlier, the law repeals the definition of extra benefits and other provisions that require the provision of extra benefits. By this action, it removes the comparison, the prior required comparison of general employee pension benefit levels to police and fire pension benefit levels. The law also removes the statutory basis for the current Naples letter interpretation. So effectively, the Naples letter interpretation will be voided after on tomorrow, July 1st, but there is the grandfather that will apply for the next 3 years. Again, the emphasis of this change by the legislature is that the minimum benefit levels must be met, except as otherwise explained previously by me. Effective date tomorrow. If you need to obtain this premium tax distribution information for those years, and if you can't link to it for any reason, please contact either one of those two folks listed, and we can get that to you. And then that's my contact information. If you have any other questions, and we do have some questions. I don't know, Jan, can you answer how you print the presentation?
Well, they should be able to just click on the document, but we also have those documents posted in our website after the webinar.
Right. This presentation and the PowerPoint will be posted on the League's website. It may not be in the next 10 minutes, but if you check back tomorrow sometime, yeah, then probably sometime tomorrow. Some of these questions may be too specific for me to answer. The next question is, our plan was closed at the last round of bargaining for the contract period. There is and continues to be excess premium tax funds that have yet to be addressed. Assuming we operate under no mutual consent. So you have a closed plan, you have some type of a legacy plan, and you operate under no mutual consent. What happens to the 50% presented as being available to fund unfunded actuarial liabilities? If there aren't, well, if the plan has, and the legislature did address this, but the law does. My PowerPoint didn't address it, but the legislature did. And if your plan doesn't have any unfunded actuarial liabilities, guess what? All of the money that's accumulated goes into the defined contribution plan and goes for special benefits for the employees. And yeah, so the money would revert back to the DC requirement for the plan, or is it still until we have a UN? And I believe that if you operate under no mutual consent, there's no saving the money. It's going to be swept statutorily, and the actuary, if you're operating under no mutual consent, will be operating under the provisions of the law, and will make those, as directed by the Board of Trustees, will very likely make those allocations. Let's see, if the contract expires and you are still in status quo but have not declared impasse, are you still in mutual consent? That's a great question, because the Department of Management Services is going to be generating some questions and answers. And I've asked that specific question because it was clearly intended that these changes to Chapter 175 and 185 were not intended to affect general collective bargaining laws. And that is, if you have a carryover contract or something, and that the status quo is maintained, and therefore there has been no formal determination of consent or no mutual consent. I would argue that there is no mutual consent only at the time of when a contract is imposed by the employer, the city, and the effective date of that imposed contract, because they can only apply prospectively. And so I would say that you continue to be in mutual consent until a new contract is imposed. Now, we'll see as the Department of Management Services comes up with some different analysis and interpretation. I don't even know if they're going to address that in this current round of questions and answers, but we know that's a big one that's hanging out there. You mentioned that the legislature should not have used the term defined contribution plan versus a share plan. Can you elaborate? I think it's just more semantics. I think when you refer to defined contribution, folks, for some reason, envision a self-directed 401k type plan or 401a defined contribution plan for governmental entities. And but don't get hung up in their use of terms, because the DMS is going to be interpreting this primarily as being a share plan. If your city, for some reason, wanted to create a self-directed a defined contribution type plan, which I would not suggest you do, then you're going to have to spend some time with DMS to make sure that that plan operates according to all the provisions in chapters 175, 185, including the restrictions on what investments can be made. Okay, what date does the administrative budget have to be approved and in place by? That's a great question. I don't think that there is any different effective date. So I'm looking in the bill right now, and I did, the actual bill. Please copy this out and have it at your fingertips. But I would say that the bill is effective on tomorrow, July 1st, and that if your plan operates on a 10-1 fiscal year, then it won't have to. DMS may have a different interpretation, but my interpretation would be that they're in the current fiscal year. They were not required to have a budget for this current fiscal year. They continue to not have to be required to have a budget for this fiscal year. However, beginning on 10-1, if that's the plan's fiscal year, they would in fact have to adopt it at that point in time. What date does the administrative budget have to be approved? And okay, I just did. And when you say approved, it's approved by the Board of Trustees. The budget does not have to be approved by the city. It just has to be provided to the city as a piece of information. Let's see. If no union, how often do you have to reach mutual consent? All right. If you don't have a union, how often do you have to reach no mutual consent? You know, I've had that question, and you could argue some type of a constructive mutual consent by action, or non-action of the employees. I would probably advise to be a little bit more conservative, and that is every year you would probably want to get a majority of the officers or the firefighters to formally acknowledge that they consent to the use of premium taxes. Does this affect the stop-start agreement that was in place in 2012? Okay, stop-starts, guess what? That's a concept under the extra benefits law. I'm sorry, you're going to have to put on a new thinking hat. Stop-starts, yes, are going to be affected, because stop-start was a concept that DMS allowed under the 1999 law. You're going to operate under a consent or no consent basis. If you have no consent, all of your premium taxes are going to be spoken for, as I just explained, in those various pots. Unfortunately, stop-starts, they will stay in place for your current collective bargaining agreement, but at the end of that collective bargaining agreement, there's going to be a new paradigm and a new law in effect. Next question. If the sponsoring union are currently under negotiations and the premium tax revenue is received, where should it be deposited? No share plan exists currently. They're going to be transitional hitches. I think everybody sees that and understands it. What you don't want to do is position yourself to where the Department of Management Services is going to deem your plan not to be in compliance and therefore withhold your premium taxes. That's the last thing you want to have happen. So if you're currently in negotiations and you have not reached a formal agreement, guess what? There's a new day as of tomorrow, July 1st. Your plan, your collective bargaining agreement, you may have to go back and to the table and create a share plan to incorporate into your plan document, to have it, to go through the administrative process and add it to it in order to make sure that your plan is in lockstep with the statutory requirements, as the DMS will very likely interpret them and impose them. And I don't think you want to jeopardize your receipt, your distribution coming up in September or October of premium tax revenues. 1999 legislation obligated cities to create share plans. Have they provided any method to amend those? I don't remember the 1999 legislation obligating cities to create share plans. It said you had, the 1999 law said you had to provide extra benefits. Many cities provided extra benefits through the creation of share plans, and there were some cities that had what are called supplemental plans that were in place prior to 1999. Those plans have been addressed in the legislation because those plans are operated by what are called supplemental plan municipalities, supplemental plan cities. And under the provisions of the law, those agreements are, those plans are deemed to be in mutual consent. But that will probably require a little bit more analysis. Please provide with the the city has a 2.5% multiplier, and we would like to get clarification on how the 3-year additional protection works with this accrual rate remaining at 2.5 beyond 2018. Okay, you're going to have to, number one, determine was the 2.5% multiplier, well, number one, even under consent or no mutual consent, you can continue with a 2.5% multiplier for forever. And let's assume that you know, if you operate under under mutual consent, you're fine. If you operate under no mutual consent and you're at 2.5%, you're at something lower than 2.75, you can stay, your accrual can stay at 2.5. All of the other plan benefit levels have to be at least the minimum benefits, but your city is not going to have the authority to reduce benefit levels to all the way down to the minimum benefits, operating under no mutual consent, if you want to stay at 2.5. Basically, your plan will stay in place the way it is. If your city wanted to, for any reason, reduce any benefit level down to at least the minimum benefit level, again operating under no mutual consent, then your plan would have to provide at least 2.75% multiplier. Operating under mutual consent, there's going to need to be an additional analysis because we have this October 1st, 2012 date. I don't know if your 2.5% accrual rate existed as of that date or not. If it did, it will fall under that protection. If it did not, we're probably going to have to do a little bit more analysis on that. Let's see. Does this penalize cities that relied on the Naples letter? Well, I wouldn't say it penalizes your city, but you got to remember the Naples letter was a department interpretation. It did not have the force and effect of statute. It was the department's interpretation of how they were reading a statute. I would characterize this as not penalizing cities that relied on Naples because, number one, this is a collective bargaining process. You're required to go through this typically on an every 3-year time frame. Now, you may have an agreement with the unions that you would like to have last 30 years, and that may be what you all had in mind, but technically, your agreements last only 3 years. And the legislature has the authority to come in and change the law every year if it wants to. Now, it's not going to want to impair contracts, and so that's why the current legislation is drafted the way it is. But during your next round of collective bargaining, then there's just going to be subtle changes in how you negotiate with your employees and their bargaining units, and the use of premium taxes, and for the benefit levels. We have a one plan administered by for both fire and police that exceeds the minimums. One time on police is union, fire is not. Fire has always benefited from what we negotiate with police. How do we handle that with mutual consent requirements? I kind of addressed this. If you have a union, you're gonna have to go through the collective bargaining and enter into an agreement. If you don't have a union, then I would take the conservative route, and on an annual basis, want to have at least a majority of those officers sign something that says they consent to the benefits or to the use of premium taxes for whatever purposes you have for the plan. I know we're going over, but I want to go ahead and go through these questions for those of y'all that are staying on. Does the plan sponsor or the plan bear the cost of creating the share plans and the legal costs associated with making the changes to the plan? That is the plan. Only the plan sponsor can amend the plan. The Board of Trustees has no authority to amend the plan. So this is going to be an expense that more than likely will be picked up by the plan sponsor. You know, if you work out an array, well, I'm going to stick with that because you know the fund is the actual pension fund is there to provide for you know, the provision of benefits. Whether or not you could argue that this is actually a plan expense that should be picked up by the fund, you know, we can have that discussion. But I'm going to say that this nominal administrative cost, just off the top of my head today, should probably be picked up by the plan sponsor. By what method do you have non-union employee give consent? Well, you're going to ask them to sign some document. We can talk offline as to how that would look, but that's how I would approach that. If not, you're going to be stuck in a position of having to argue some type of constructive consent if you're ever challenged, and I just don't know if you want to position yourself that way. Can a share plan created subsequent to the 1999 legislation be amended? Sure. I don't. Again, it may require collective bargaining. The legislature hasn't really dictated how the share plan has to look. I've seen various iterations of share plans. Some give a high level, you know, more benefit to longer term employees and lesser benefit to employees with less tenure. But I would think that you can clearly amend your current share plans. Let's see, share plan created subsequent. Yeah. Okay, so those are the questions that you all have submitted up to now, and I appreciate your indulgence and your time this afternoon. Again, we're going to be this will be posted probably at the latest sometime tomorrow. The presentation as well as the PowerPoint. The document that I sent to you yesterday, entitled the Summary Document and Worksheet, that is basically all the information that we just went through under this presentation is included in that document. It has a separate worksheet to work through to generate these various pots of cash. So spend a little time with the summary document and worksheet, and if you have any additional questions, feel free to give me a buzz, and we will take it from there. So with that, do you have any other announcements? Okay, thanks a lot.